Good afternoon. Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We've been coming to you live from the Nasdaq Philex Options Trading Floor in Philadelphia. Joining me for this segment is Brian Quigley. He's portfolio manager of the fixed income group over at Vanguard. Brian, thank you very much for joining me on the floor today. I would imagine it was a busy week for your team. On Wednesday, of course, we got the fourth interest rate hike out of the FOMC, the second interest rate hike out of the FOMC. How have bonds been reacting to this announcement and, of course, what they said going forward?
Sure. Yeah, so the really interesting thing is that we saw a very muted reaction from the bond market on Wednesday following the announcement. You might have expected that treasuries might sell off, given that higher interest rates are negative for bond prices. But the fact that we saw such a muted response really speaks to the fact that the Fed is providing unprecedented amounts of forward guidance. This forward guidance is allowing the market to anticipate policy changes before they happen. And to price them into the market in a gradual manner before the announcement. So as far as Wednesday's announcement goes, the market had anticipated it for a long time and priced it in well in advance of Wednesday's meeting.
What does 25 basis points mean to the bond market?
It depends on where on the yield curve you are, and it depends on how well telegraphed it was. And in the case of the Fed, they've been telegraphing their rate increases, well in advance. And so on a day-to-day basis, it doesn't mean much for the market. And I think that's what we saw this past week.
Now, you're the portfolio manager of the Vanguard Core Bond Fund and Vanguard Short-Term Federal Fund. How will this interest rate increase the funds that you manage? Sure.
So for short-term federal, it's a short-term fund. It has a short duration, so it has less sensitivity to interest rate changes. Mm-hmm. It holds government-related securities, so that there's less credit risk inherent in the fund. So in the case of an economic downturn or credit concerns, the fund's pretty well insulated. Core Bond Fund is more of an intermediate-term bond fund. It has more interest rate sensitivity. And it offers bonds, it holds bonds that offer more spread over government bonds, so it has a higher yield.
Should interest rate changes affect the way investors look at their portfolios?
At Vanguard, we don't think so. We're always telling our investors, we really advocate for investors to take a long-term approach. When thinking about their allocation between bonds and equities, they should be thinking about their long-term investment goals. They should be thinking about their long-term risk tolerance rather than trying to time interest rate changes. Nobody knows when the Fed will be done raising interest rates. If you think about bond yields have risen a lot over the last couple of years, and that yield is compensation for interest rate uncertainty. So investors are well compensated today for interest rate uncertainty. We think that, despite the fact that the Fed is telegraphing that they'll continue their forward or their future rate increases, we anticipate that bond yields are fairly priced for that. And so investors should take a long-term approach, and they should focus on their long-run goals and not try to time the market.
Well, we keep hearing about the Fed reducing its balance sheet. How has that changed the bond market landscape?
Yeah. It's a great question, and it's difficult to answer. The market's really struggled with how it will anticipate what the impact of this is going to be on the market. I think the one thing that we can say is that similar to their interest rate guidance, the Fed has been very transparent and very forthright with how they're going to reduce their balance sheet. So well in advance of announcing the actual reduction in balance sheet, they started talking about this. They laid out a plan several months before beginning, and they laid out the pace at which they'll reduce the balance sheet. So the market's had plenty of time to adjust, plenty of time to anticipate. And we think the market's fairly priced. You may see some impact, but it's not going to be disorderly or disruptive.
Right. I mean, they've been telegraphing it for months at this point, so it shouldn't be a surprise that a headline's going to move the tape. So what would you expect to wrap up, the future of the bond market to look like, assuming that they stay on the path that they're on now?
Yeah, I mean, I think it's going to look similar to what it looks like today. I mean, the Fed reducing their balance sheet is a net supply to the bond market, but markets adjust. If that means slightly higher interest rates, investors will come in and buy bonds, to take advantage of those higher interest rates. So I think it's going to be an orderly transition. And I think that's what we're seeing today.
All right. Well, thank you very much, Brian, for joining us on the floor. And thank you for joining me today. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.